Did you see that news clip?
Leave a comment below.
Make sure you like and subscribe.
Make sure you like and subscribe.
Welcome to another episode of Clips of News. On today's episode, I want to share with you all some information about the infrastructure bill, the bipartisan infrastructure bill. Bipartisan just means that both sides of the political line have agreed on something. So that's why it's called bipartisan and not partisan. But so in this infrastructure bill, in the bipartisan infrastructure bill, there is a section that talks about cryptocurrency regulation. And I found this news clip, and I just thought that this news clip was really nice as far as like explaining to people what may happen when it comes to cryptocurrency regulation. As of now, it's not really taxed. You know what I mean? It's taxed, but it's very hard for the government to know how much you actually made, because as we all know, crypto wallets don't have a name on them. There's no real way to identify who owns what wallet, and really that just depends on the platform that you're buying the cryptocurrency on and where you're holding the cryptocurrency and where you take the profits from. But in which case, what the government wants to do is they want to regulate it more heavily so that they can know how much you made, how much you took, and basically how much money they should be getting off of you. So I just wanted to share this news clip with you guys because I thought it was pretty good. So let's get into it.
I want to talk now about the infrastructure deal because it has largely been about rebuilding America's roads and bridges and railways and communication services. But it also has a provision to increase regulation on cryptocurrency. We're joined now by Lisa Ellis, partner at MoffettNathanson. So Lisa, let's just talk briefly about what these new regulations are that could be coming down the pike in this infrastructure bill.
Yeah, it's always a little bit, unclear initially because what happens in the final language is never always exactly how it starts out. But what it looks like it's kind of converging around is additional reporting requirements for the crypto brokerages. So this would be players like a Coinbase, a Gemini, a Kraken, even players like PayPal, Square, or Robinhood that enable their users to buy, sell, and hold cryptocurrencies, functioning as brokers essentially, that they would have increased reporting requirements that require them to report to the IRS, the information about the transactions, particularly large transactions like greater than $10,000, more information about when they occur and who's involved, etc.
Lisa, do you think that this may hasten a cryptocurrency ETF in the U.S. when we finally get these new provisions from Washington?
That's well, it may help, I suppose. What's been holding up the crypto ETFs is that the SEC has very stringent requirements for things like liquidity, transparency, price stability when it comes to being willing to establish ETFs for certain asset classes. And so far, they've been wary of the crypto assets around whether or not they make those requirements, too much. So certainly regulations in the U.S., particularly if other countries around the world sort of follow suit, that requires another level of transparency into crypto-related transactions, would probably help allay some of the SEC's concerns around that. In the meantime, though, the IRS, of course, they're just trying to increase their tax revenues because many consumers either deliberately or just are unaware that they are in fact supposed to pay capital gains taxes on crypto investing. And so, but the problem is that the IRS today doesn't really have any particularly good way of auditing that because they don't have visibility into the transactions. And so they're just trying to get this reporting level up so that they have a better ability to audit transactions and collect capital gains taxes.
You saw that there. Like she was saying, the main reason for that background noise is the rain. I just felt like I had to say it. I probably should have said it in the beginning, but whatever. So that what she was basically saying in that news clip is, like I said, because the government can't see who owns what crypto, like the wallets have no name on them. They have no oh, this belongs to Joseph Bristol who lives in Florida. You know what I mean? Because it doesn't have that, it's very hard for them to collect taxes from us. So essentially, you bought Bitcoin at $3,000, it shoots up to $60,000 and you sold it. Yeah, you're supposed to pay taxes on that. But if they don't know that you have the money, you don't have to pay nothing. Because when you put the money into your bank account, if you're putting in piece by piece dollars, $1,000 a week, $2,000 a month, something like that, you can easily say, well, somebody gave me that money, or I earned that money from my job. You don't necessarily have to say that's my cryptocurrency money. So that was why they want to have the brokers start to tell them who owns what wallet and how much they own inside of each wallet and what they have and did they sell and so on and so forth. So that's a part of the regulation. Now, I found this article online talking about like the taxes and how the taxes work, because not everybody's going to have to pay taxes. If you bought Ethereum at $1,000 and you sold it at $3,000, honestly, you don't have to pay taxes on that money, depending on your situation. So now I'm going to show you all this website. All the links are in the description as far as the video and the article that I'm pulling this information from. But let's go now. But long-term capital gains taxes is when you buy a crypto or you buy a stock and you keep it for a year or longer. That's long-term. Short-term capital gains taxes is anything less than a year. So you bought it this month, you sold it 2 months later, or 6 months later, 9 months later, 10 months later. That's a short-term capital gains tax, right? So now let's go into what I'm talking about here. So I want to bring you guys to this part of the article right here. So long-term capital gains tax for a head of household up to $54,000. So what that means is that, let's say you file a head of household and your income is less than $54,000. And when I'm talking about income, I'm talking about what you worked for at your job, including all your taxes, all your stocks that you sold and all the crypto that you sold. If it doesn't add up to $54,000, you actually don't have to pay anything on your crypto that you bought and sold over a period of a year, right? So in that essence, if you bought Ethereum at $800 2 years ago and now it's up to $3,000 and you sold it this year and your income is less than $54,000, you don't have to pay the taxes on the gains that you made between those years. Should you still file for it and put it on your taxes? Yes, you should, because the IRS, they don't play that. If they audit you and they see that you got income that you ain't been reporting, that's going to make them want to audit you even more. And remember, the people who are mainly audited, the people that they mainly go after are poor people. They're mainly going after anybody who receives an income tax check. Because if you're getting an income tax check, you are poor. You might think in your mind, oh, I'm not poor, I got money. If you get an income tax check, you are considered to be poor, because you have paid the government more money throughout the year than what they're giving you at the end of the year. And if you don't believe me, look at your pay stub, add up the money that you've been paying the government, all the money that you've been giving them in your taxes, and then look at how much they give you back at the end of the year. It's not going to be an equal amount. You give them more than what you get back. So the goal is to always, what you want is to make so much money that at the end of the year, you have to give the government money. That's the goal. You want to make so much money that you have to pay taxes as opposed to getting an income tax check. That should be your financial goal. But this is how the capital gains tax works. This article is here for you guys if you want to read it. I thought it was very helpful. I read it. It was very helpful to me to understanding as far as what I have to report and what I don't have to report. Although, again, I will say you should report all of the crypto, all of the stocks that you sell, even if you only made $20 on a buy and a sell, you should report it because you may potentially have to pay taxes on that. Short-term capital gains tax, though, is very different on short-term buying and selling, because that's taxed at your income bracket. It's not taxed at like capital gains. So it's taxed at a much higher rate than if you would have held it for a year or longer. So I just wanted to share that information with you guys. I thought that this article was really good. We should definitely pay attention to the infrastructure bill if you're into crypto, because like I said, they're trying to squeeze in regulation into this infrastructure bill, in which case, if you buy and sell crypto like I do, it's something to pay attention to. It's something to know. All right. So thanks for watching another episode of Clips of News. And let's all remember, man, that we all out here just trying to do the same thing. Just be happy and survive. Y'all stay blessed.